Started. So just to introduce ourselves, my name is Rebecca Shepard. I'm here with my colleague, Peter Huckabo, and we are tax attorneys. And we've been tax attorneys for about a dozen years each. So together, we've got quite a lot of experience. Before the pandemic, our clients were restaurants and bars and entertainment venues, doctors' offices, and other small businesses that were kind of on the bubble of viability. So we helped people with sales tax issues and payroll tax issues and sales tax audits and gross receipt audits for admission into venues and things like that. And when the pandemic hit, we knew that we needed to dig deep into the CARES Act to figure out how to help these people. What were we going to do? And so we started with PPP. At the time, you couldn't use PPP and ERC together. And so we were really focused on PPP and getting our clients as much money as quickly as possible to help kind of weather this storm. And then I don't know if you all remember, but the rules changed about 100 times in the period of about 12 weeks. And so Peter and I kind of like rode those waves as quickly as possible. So as soon as we gave advice, 3 days later, the rules changed and we had to give different advice. So at that point, we were able to help clients get, that full forgiveness. You had 24 weeks. I think the amount increased to about $20,000 per employee, but you still couldn't use ERC and PPP together until December 27th of 2020. And that's when Congress changed the rules and said you could use the two programs together as long as you didn't use the same dollar twice. And that changed everything. So then we started going back to our clients, the restaurants and the bars, all these places that were shut down due to the pandemic, and determined their eligibility period and, requested refund, got them refund claims that sometimes paid their entire tax liability, sometimes even above that. It was really incredible to see. And it allowed us the opportunity to kind of start this informational campaign to help viable businesses or possibly non-viable businesses or anyone that's able to take advantage of this employee retention credit program. That has kind of morphed into us helping in other areas and Peter will talk about this, WOTC, the different type of tax credit. I'll talk to you about the research and development tax credit, other ways to structure your business and to possibly, save you as much money as possible. Because right now, especially like possibly on the beginnings of a recession, every dollar is really going to count. So with that, I will kick it over to Peter.
Thanks, Rebecca. All right, so we know you're getting hammered with ERC texts and emails and smoke signals and all this kind of stuff, but part of effective planning, is making sure that what you've already done is correct and identifying whether or not you need to take corrective action to mitigate any risk. So we're going to start with some ERC stuff. We're not going to, continue this whole presentation about it, but I just want to make sure that everybody's on the same page about what it is and what it isn't, because the IRS is starting to pay attention. And, Rebecca mentioned that, December 27th of 2020, they changed the rules, and, subsequent legislation after that changed the rules again and again and again. And, absent some notices that came out from the IRS, adding a little bit of color to the rules, but not a ton. You sort of had a vacuum where you had a lot of these pop-up shops, doing this work. And finally, last October 19th of 2022, IRS finally said something about it. And they said, warning, some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit, and reminding people that improperly claiming ERC could result in taxpayers being required to repay the credit along with penalties and interest. All of that is true. We were attendees at the tax fraud and controversy conference in Las Vegas in December. You had IRS civil enforcement there talking about how they were going to add this to the Dirty Dozen list of promoter schemes and warnings. You had criminal investigation division saying we're absolutely looking at this stuff. What has happened, over the last 30 days is we've had an additional statement being released from the Office of Professional Responsibility, and then the actual addition of ERC to the Dirty Dozen list, which is, publicity thing that the IRS puts out annually to say, hey, these 12 things, pay attention to it. They put ERC 1. It was the first one that came out late last week. So we're just going to run through some basics here to make sure that you guys understand, the position that you've taken on these returns and exactly what it means, if you're ever audited. If there are concerns, about overclaiming or things like that, it's worth taking the time now to figure out what's going on. With that, I'll give it back to Rebecca.
Thank you, Peter.
Yes.
Very specific introduction. A lot of times he just waits and stops talking to see how quickly I can respond, but I'm always like a ninja, I go very fast. So how do you get the employee retention credit? First, you need to be an eligible employer. So you need to be carrying on a trade or business in the calendar quarter for which the credit is determined. And there are 2 ways to qualify. Either you had a significant reduction in gross receipts or a suspension of operations due to a governmental order. The first is the easiest way, a significant reduction in gross receipts. So for 2020, you just look at your dollars in the door for Q2 of 2020 or Q3 of 2020. It's a quarter over quarter analysis, 2020 compared to 2019. Your gross receipts went down 50% for any quarter in 2020, going to be eligible for that quarter and the subsequent quarter. For 2021, instead of going down 50%, all you need to go down is 20%. So all you need to have is a 20% decline. You're going to be eligible for that quarter. Again, you're comparing 2021 to 2019. Now, there are alternative reference periods for 2021 that allows for an automatic qualification for successive quarters. We've had a lot of success with this. So one of my clients is a law firm, and in Q2 of 21, their revenue went down 22.3%. In Q3 of 21, their revenue went up 3,000%. They had a big settlement come in and they crushed it. Because their revenue went down by the required amount in Q2, they were automatically eligible for Q3 2021. There is no question that they are eligible. It's not something where you need to show there was a need, that there was some sort of COVID requirement due to the reduction in gross receipts. It can be for any reason whatsoever. Your gross receipts went down, you're now eligible. So we help in these types of cases, but really where we show our value is in the next type of eligible employer. And that's when there's a full or partial suspension of a trade or business operations. Now, your operations of trade or business is going to be fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings because of COVID-19. So in this one, you need COVID-19 and you need a governmental order. We will ask people, how were you impacted with COVID? And they'll say, I couldn't get the straws that I normally get, or, people just weren't coming to work. That's not enough. You need to have a governmental order that's actually restricting you in some way. So we want you to think about it as like eminent domain, where the government came in and built a road in your backyard, and now you're not able to use that part of the backyard. It's not that you're choosing not to use that part of the backyard. It's because the government actually came in and took that away from you. It was a taken. And so because of that, you're going to be rewarded with this credit. Now, the taking needs to be more than nominal. So the IRS defines nominal as 10%. So if you're looking at something where it's a full suspension of operations, so say indoor dining, I'm sure that affects some of you, that full suspension of operations, you're going to be looking at 2019. Make sure that your revenue or hours worked are more than 10%, more than a nominal portion of revenue. And at that point, if so, while you're suspended, then you're going to be eligible for the credit for that period of time. So that's if you're fully suspended. But what happens if your dining room is open, subject to modification, subject to 6-foot social distancing or capacity restrictions or something like that. That's the case, then you're looking forward and you're going to check and see whether or not that government restriction had more than a nominal effect on your ability to provide goods and services. So that gets very tricky because now you have to take into account all of those carryout sales that you got during the pandemic. Maybe you built a drive-through. So how did that impact your overall sales picture? It doesn't mean that you're not an eligible employer. It just means that it gets a little bit more tricky in order to analyze. And these are the questions that Peter and I will bop around during the day to make sure that we're filing the claims properly.
And this is where this stuff gets hard. And, assuming you've already filed and worked with someone should be working through, what are the metrics that you would, discuss with a revenue agent if you were audited? What are the documents that you would show them? How, why does this work? Nominal, it's not meant to be a big mountain between you and this refund, but you need to be able to identify what you would use to substantiate this, because it's going to be a whole lot easier to do it now when we're only 2 and 3 years removed from this than, if somebody took you all the way through Q3 trying to substantiate that 5 years from now, going back, 8 years to try to find the eligibility. So that's where this stuff gets hard. Just if you have concerns, make sure you work through them now. Quickly, there is a third method of eligibility called a recovery startup business. By definition, that business began operations after February 15th, 2020. Additionally, it had average gross receipts of less than $1 million. It doesn't qualify, under method 1 or method 2. So, this is just to remind everyone, you can be a recovery startup business in 1 quarter, you can have a significant decline in gross receipts in another, and you could have a full or partial suspension of trade or business operations in a third. The catch for recovery startup business is it's $50,000 per quarter and only eligible in Q3 and Q4 of 2021. It is the only way to be eligible in Q4 2021. So if somebody's told you differently, you may have some issues there. But look, policy behind it, you took a risk during a pandemic, you started a new business, you survived the Q3 and Q4, and you had employees. And that's really the only requirement there. Just some special issues. I'm not going to go into details on this, but if you're listening to this and something is triggered, the thing to keep in mind is the employee retention credit is built on top of existing tax code. And there are situations where you have controlled groups of corporations, meaning, businesses that on paper do not seem to be related, and they are considered one employer for the purposes of the credit. And there are many strange rules about how you can get controlled groups to include situations where husband and wives have minor children under age 21, and that minor child is considered owning both of their businesses. So there's weird things here that if you went through the analysis with the RC and did not have these conversations with preparers, you may have some issues. There are also issues about wages related to majority owners and deemed owners. So these are family attribution rules. If you have close family members working in the business, you've got to slow down and work through those issues to make sure you didn't overclaim. There are certain safe harbors related to the acquisition of a trader business during COVID, and making sure that you've taken into consideration some aspects of that. So if you acquired a business, there's some opportunity to have some footfalls there. Just to remind everybody, the refund statute expiration date is what controls the due dates here. So if you haven't filed for calendar quarters related to 2020, you have until April 15th of 2024. For calendar quarters related to 2021, you have until April 15th, 2025. The assessment statute expiration date, which is being re-triggered from the time that you file, is at a minimum 3 years from the time of refiling. So this is how long the government could come in and audit you. And then 5 years for quarters 3 and quarter 4, 2021. There is talk of trying to extend it to 5 years for all of the quarters. As of yet, I haven't seen that movement from the government, but it was at least included in the president's budget. And then lastly, before we move on, just special issue. If a preparer wasn't discussing with you the operation of code section 280C, you may not know that this is generating taxable income. So that code section basically says, in this context, if you get a credit based on wages paid, you lose the deduction for those wages paid up to the amount of the credit. So if you had eligibility both in 2020 and 2021, you need to go back and amend your business income tax returns. If you are a pass-through entity, that is trickling down to the owner's 1040s, and they need to pay tax on that. This is an area where it would be very easy for the government to run some reports and figure out, okay, these businesses got ERC, we don't see corresponding amendments. So you really need to go in and amend to avoid any issues with penalties. All right, moving on.
Just really quick, for those of you who are with us still, how many of you actually claimed it already? Claimed the employee retention credit already? Did you already? And if you did, like, have you already gotten your money? Like, do you have any questions about it? You can either just talk, or you can put it in the chat, or we can move on to the work opportunity tax credit. That's fine too.
You guys are welcome to unmute yourselves. We're a small enough group that, if there are specific things related to ERC or anything else that you want to talk about, just chime in. Work opportunity tax credit, also called WOTC, is another program that has been extended, as a response to COVID. It's a federal tax credit available to employers for hiring people from certain targeted groups, and we'll go through what those groups are. But generally speaking, it was set to expire at the end of 2020. It's been extended to December 31st, 2025. We are not talking the same numbers as ERC. So, in the order of magnitude, ERC up to 26,000. In the best case scenario for WOTC, it's up to 9,600 per employee, and that's like a very cherry-picked and specific employee. So most of these are going to be worth $2,400 per employee, as high as $9,600. The way the math works on that is it's a 40% of qualified wages. Qualified wages are generally capped at $6,000. The way you get to that bigger number is if the cap on qualified wages goes up in a very specific situation with a qualified veteran with a service-connected disability and at least 6 months of unemployment. Within the 1 year preceding the hiring date, qualified wages pop to $24,000. So this is a credit, and we'll talk through, how it works. It is not a refundable credit. So it is a dollar for dollar offset of tax. And you don't necessarily lose it if you can't use it all in 1 year, and we'll talk about that, but it's not the same as ERC. But if somebody's going to give you a credit that is dollar for dollar, for hiring members, certain targeted groups that you may be hiring anyway, it's something additional to look at for the next couple of years. So, we're happy to provide this slide deck so you can see exactly what the details are. I'm just going to run through quickly what the different groups are. So qualified 4A recipient, qualified veterans, qualified ex-felons, designated community residents, vocational rehab referrals, qualified summer youth employee, qualified SNAP benefit recipients, qualified SSI recipient, long-term family assistant recipient, qualified long-term unemployment recipient. So that's, generally speaking, these are your targeted groups. Congress has identified, who these groups are, and they want to say, we will benefit a business who hires these folks. So devil's in the details. How do I actually go about doing it? Because they're going to make you work for it a little bit. But again, for $2,400, that is a direct offset to tax. It might be worth it for you. So the big thing is you have to do a pre-screening. And so you need to fill out this form 8850. And that form is asking for some very specific things. You need to know the date that the applicant gave you the information about their being a member of a targeted group. You need to document the date that the job was offered, the date that the individual was hired, and the date they started the job. And you have to file this with the state workforce agency. each state has its own workforce agency. Someone who is administering this program and processing these pre-screening forms. So important to remember, you only have 28 days from the person beginning work to get this filed. But what's going to happen is someone from that state workforce agency is going to say, yeah, we agree. They're part of a targeted group. That's it. That's all you got to do. Beyond that, it is working with your income tax preparer to actually claim the credit. The form itself is a 5884, which rolls up into a 3800, which rolls up into your actual tax return. But the point is, it is claimed annually on the business's income tax return. You know, if you're a sole prop, it's on your 1040, partnership 1065, C Corp 1120, pass through S Corp 1120S. This last bullet point, WOTC is not a refundable credit. You mentioned that. But you can carry it back 1 year and then forward for up to 20. So you're going to have an opportunity to use this. Once again, it is $1 for $1. So if at the end of the day, you know, your tax return shows a balance due of $2,400, but you have a $2,400 WOTC credit, you're paying zero in tax now. So again, if these are categories of individuals who you are hiring anyway, it makes sense to put something in place where you can actually take advantage of this particular credit.
Real quick, well, I guess it's my turn anyway, but we have a question. Is there a limitation on number of employees that disqualifies you for ERC? Like there's a lot of like negatives in that sentence, but I'm not sure if you're asking, is there an employee amount that's too small? And that answer is no. As long as you have one employee, you can qualify. Your credit may not be very large, but you can qualify. If the question is, if you have too many employees, does that impact your eligibility? Okay. So you'll be an eligible employer, but you can only count qualified wages depending on whether or not you meet these certain criteria. So for 2020, if your full-time employees are below 100, then you get qualified wages on everyone. If your full-time employees are 103 or 101 or whatever, then you can only take the credit on qualified wages that were for paying people not to work. If you're over 500, then it's the same thing, but for 2021. So if you have, and the important thing to remember is it's full-time employees. And so there's definitely been times where people have received improper advice and were told they don't qualify because they thought there was an FTE component, a full-time equivalency, and that's incorrect. It's literally counting how many employees that hit 130 hours a month. How many you have in January, say it's 390, and then in August, maybe you swell to 700, but it's possible that your average for the year would still be below 500. And that's going to be worth it to double check every time, because if you have that many employees, then your credit could be relatively large. Do you want to add anything?
No, I agree. I mean, breaking it apart in your mind between an eligible employer analysis and a qualified wage analysis, it's two different things. The other thing, when you get into employee count issues, the thing to keep in mind is, you know, making sure that if someone did a controlled group analysis, to make sure that it is actually a controlled group, because we've seen situations where, you know, you're doing a brother sister control group analysis and really they don't get to controlling interest, or really there isn't effective control, and there's been you know, issues there as well.
The biggest takeaway, I think, from everything is double check. There's gonna be a point where you can't do it anymore. So double check. So places like us, like, we scope for free. So feel free to waste our time, but feel free to waste anyone else's time that's willing to do this also. Make sure that somebody's doing a proper analysis. Now, if you think you're at 700 and someone comes back to you and says you're at 75, ask follow-up questions. How did you get that number? I want to see your calculations. I want to see your work papers, all of that. But it's always worth it to check with an accountant who's actually like doing the bean counting and making sure that your numbers are right. Okay, section 179 and bonus depreciation. And these are similar sides of a same side of a similar coin, similar sides of the same coin. I'm not really sure. But really the point of all of these slides are you want to make sure if you're buying equipment, you want to buy it before the end of the year, like December 30th instead of January 5th. And it's very likely that there's going to be a better tax incentive for you to depreciate the entire piece of equipment in one rather than spreading it over its useful life. But just, does anyone, are we good on the ERC stuff? Does anyone else have any other questions? I guess I should have asked before I continue. Anonymous attendees not responding, so I think we're good. Depreciation expenses may be taken in the ordinary course to write down the value of an asset over its useful life, i.e. capitalization and depreciation. Bonus depreciation is a tax incentive that allows a business to immediately deduct a larger percentage of the purchase price of an eligible asset. The bonus depreciation is only applicable to certain business assets, including only property with useful life of 20 years or less. And there's some other rules to pay attention to as well. I wouldn't suggest you guys do this stuff yourself, but these items that we're talking about here, WOTC, ERC, depreciation, and we'll get into R&D in a little bit. These are like issue spots for you. So make sure that you're talking to a tax professional and you're like, oh, you know what? I did think about this and this is what I want to think about. Do I qualify for this portion? Just make sure that like no one's thinking exactly what I say and then going to automatically deduct something that there might be attached to. So additional rules, asset was not used by the taxpayer prior to acquisition, not acquired by a related party of the taxpayer. You need to have like an arm's length transaction. That makes sense. So the Tax Cuts and Jobs Act, which in colloquial we all know is like the Trump tax cuts, implemented a bonus depreciation schedule that phased out in January 1, 2023, that said you're entitled to 100% bonus depreciation. For 2023, it's 80%. And then next year will be 60%, unless they change the rules, which they tend to do a lot. So just keep that in mind as far as, you know, when to buy something and what you're able to depreciate.
And if I can just, so the first couple of things, ERC, WOTC, we're talking about basically dollars in your pocket, right? Or offsetting tax or, you know, refunds, that types of things. What we're talking about now is strategically figuring out when I want to recognize income or recognize an expense. So, you know, Rebecca said claim it before the end of the year. Probably that's the right answer, but maybe it's not. Maybe you are anticipating, you know, something different in 2024, and you know, acknowledging that this may go down by 20%, you know, 20%. You may lose some value of bonus depreciation, but you know, maybe that still makes sense. So everybody's situation is going to be different, but the name of the game here is, well, when do I recognize this income? When do I recognize these expenses? And these are the tools to do that. Right.
And again, these are just, this is like really high level to give you an idea of ways you can save money for your business. So section 179 expenses, similar to bonus depreciation. 179 allows for immediate expense deduction for purchases, but is limited to items such as cars, office equipment, business machinery, and computers. The maximum amount for 2022 was $1,080,000. We probably should update that. States also apply limits which may be smaller than the IRS limitations. That's really important because I don't believe your state could do all kinds of different things. I know in Maryland, there's a limit on section 179 that doesn't exist on the bonus depreciation. So it may make more sense to claim it under bonus depreciation. Items purchased must be used for business purposes more than 50% of the time to qualify. Okay, bonus depreciation versus section 179. 179 expenses can be more flexible with timing. because the taxpayer can elect to save certain assets for future tax breaks or claim only a portion of the cost and defer the other portion for a future tax year. But bonus depreciation, you might be able to get something much larger. I don't know how much equipment you all are buying, but if you've got something that's like $1 million, you'll be able to do that with bonus depreciation. Okay, research and development tax credit. We are back in the tax credit world. So depreciation was telling you, how best to limit your tax. R&D credit is again an incentive to get some money. So R&D credit is a federal tax credit available to organizations that invest in qualified research and development activities. The credit provides dollar for dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. There's a 4-pronged test to determine if you're eligible. I really can't say this enough. If you think you're eligible, do not try to claim the credit. Go speak to somebody who can help you with that, just to make sure that you're within the rules. But the first prong is permitted purpose. So an activity intended to develop new or improved business component that improves function, performance, quality, reliability. It could be a product, process, technique, formula, or software. So think pandemic, did you all have to update your point of sale system to include mobile ordering? Did you do it yourself or did you buy, some canned software? If you did it yourself, it's possible that you would qualify. What about if you're a brewery and you are creating a new Huckabo Hero IPA? You're creating a new product. You're using a process to come to that new product, and you're doing it with a specific business purpose, right? You're selling that good. The next prong is the elimination of uncertainty. So an activity intended to eliminate technical uncertainty concerning capability, optimal methodology, appropriate design, process, or product improvement. I usually make the same joke to all the restaurants, which is you're testing out a new recipe, adding butter. There's no uncertainty there. It's going to be delicious. You need to actually be thinking about what is uncertain. It has to be able to fail. And that's part of it. But if you are a restaurant trying to come up with like a shelf-stable good to go into grocery stores or something like that, you are trying to determine what is going to make that salad dressing or sauce not expire on the shelf to get you that product to last longer. That could possibly qualify for that R&D credit. Slide. So process of experimentation. How do you know if your formula or your software is going to work? You've got to go over it multiple times, right? So that's kind of ties into that uncertainty. It can't just work because then you would just try it once and it would be good to go. So you have to try different technologies, different strategies, try to determine what's the best way of doing it, possibly like modeling and simulating what you're doing to create this new product to determine if you're eligible for the credit. The other piece of it is you need to have an application of hard sciences. So engineering, physics, chemistry, computer science, and other disciplines. I was a government politics major, which I think actually counted as a science, but it was like a fake science. Whereas chemistry and computer science count more as actual science, and you would need to use one of those. But, creating a new beer, creating a new bread, you're using chemistry, you're using physics. Using that app, you're using computer sciences. So it's certainly within the possibility that a lot of restaurants are underutilizing a possibility of getting this R&D tax credit. A lot. Choice of entity.
All right, so this is more about structure. We'll run through this quickly, but they're not all created equal, and there are tax consequences to certain choices that you're making. There's a limited universe of what you can choose. So from the simplest, most straightforward, a sole proprietorship, meaning you don't have any entity involved and you're doing business as you in your individual capacity. You might have a trade name or a DBA or something along those lines, but at the end of the day, it's you. That's bad for a lot of reasons. not the least of which is tax, but you're opening yourself up to, personal liability. So in that regard, you at least want to be a single member LLC, which for tax purposes is going to be treated the same as a sole proprietorship because the IRS disregards the fact that you have an entity, but at least you still have some personal liability protection. Once you get into, multiple owners and partnerships, corporations, that's when we can get into some of the tax planning. So, partnership is sort of default. So if you have an LLC, the IRS is going to say, well, we're going to tax you as a partnership. What does that mean? It means that you are going to be paying self-employment tax on the full amount of the net business income. Not particularly tax efficient because self-employment tax is 15.3%, and you're going to pay income tax on top of that. That's largely the same problem that sole props and disregarded entities are dealing with as well. There's some opportunity for planning with guaranteed payments, but again, not the most efficient structure. There are reasons why you want to be a partnership potentially, or even in certain industries, you have to be a partnership. But think twice about 1065 filings if you don't have to be, or there's not a business planning reason to be. Next are corporations, C Corps and S Corps. Rebecca mentioned the TCJA, Tax Cuts and Jobs Act, Trump tax cuts, brought the corporate rate for C Corps down to 21%. That certainly was more attractive than it was pre-TCJA. But when it all shakes out, it still makes most sense from a tax efficiency standpoint to be an S Corp. S Corps have their own limitations with regard to business choices and why you may not want to be an S Corp, or certain owners can't own an S Corp. So again, I'm talking specifically about, tax treatment, but a C Corp, you are paying 21% corporate tax and generally can control the recognition of income by the issuing and timing of dividends. It's a double tax situation where both the corporation and the individual are paying tax, but there's some strategy and considerations there. With S Corps, and why I say it's the most efficient is because the interpretation, longstanding interpretation in the tax space is that net business income from an S Corp is not subject to self-employment taxes. So you have to pay yourself a reasonable salary and you put an owner on wage, and a reasonable salary is not $5,000 a year. But by paying that wage and changing the relationship of the owner to the corporation, you're subjecting yourself to FICA tax. The pass-through income then is only subject to income tax and not also to self-employment tax, that 15.3%. So there's tax efficiency there. Making these elections and getting into the proper structure that is right for you and that you want to do is not some major thing. I mean, dealing with the history in the past and that kind of stuff, okay, yeah, there's some stuff to work through, but that can be worked through with an accountant. The mechanism for actually changing these things are relatively simple. They're called check the box elections. So don't be intimidated by working through these things. Let's work to get you into something that's more tax efficient. Did we just talk about this stuff?
I was gonna say, yeah, I think we covered this. Does anyone have any questions about this stuff? I know it's really hard to make tax interesting. We do the best that we can, but free money or money from a credit that you're getting from the government is awesome. But these other strategies are going to be helpful for you long term in how to reduce your tax consequences. And that should be like a thoughtful process. This is a good time to do it because you're still like in the first quarter of the year. You can be thoughtful on how you spend in items that you're looking at. If you think that you might qualify for the research and development tax credit, call an accountant and see. And then just one other thing, as far as like the employee retention credit, if you've already claimed and you've already gotten some money, and it feels like you might have gotten too much, it's a good time to check, right? It's not a bad idea to do a risk assessment to see whether or not you're actually eligible for all of those quarters. When I say risk, I don't mean whether or not you could be audited or anything like that. I mean, like, whether or not you can be considered to be an eligible employer. Because if you've overclaimed and you're audited in 3 years, it's going to be a much bigger problem than if you handle it now. Peter and I have been doing this and basically gave up our tax practice, our controversy tax practice, in the last 2 years and have focused solely on this. We're like Def Leppard in 1987. We will never be more relevant than we are right now. We're happy to answer any questions you all have. You've already claimed and you just want to ask a couple of questions, feel free to give us a call, shoot us an email. We're doing trainings for CPAs that do this work. We're like helping train those people. We just want everyone to do it right. And we're happy to do anything that we can to help, push that forward. That's it. Thanks so much.